So we got Marcus Addison, who's Head of Default Management at Eurex, Damien Imboden, Head of Treasury and FX at Swiss Life, Maud Timon, who's a Senior Officer in Post-Trade from ESMA, and Godfrey De Witz, Director of European Affairs at ICAP, going from my left across. So can we have the first e-vote? We just wanted to gauge people's understanding of clearing. Well, there's a slide with a vote on it, if you guys can put that up. Hooray, there we go. It's obvious, really. We just want to get a feel for how many people really do understand clearing. And then just to see if the panel's worth anything, we're going to ask you the same question at the end and find out if we actually benefited you guys at all. Oh well, so half of you can listen, the rest probably have heard it all before. So we'll see. So we met before this morning and had quite a lively debate about clearing. So I think what I'm going to try and do is kick off that debate, bounce around the panel, talk about clearing. We're going to talk about default management, about the practical implications of getting into clearing, about how the regulators feel about the issue, and Godfrey's going to talk about why should we use clearing in securities lending. Before we do that, I got a couple of slides to put up which explains what clearing is going on in derivatives. So if you could put up the first chart. There we go. So what we've got is an overview. This is from March this year, looking vertically by asset class and horizontally by clearinghouse. So we've got Europe and America here. I've been keeping track of these numbers for a couple of years now. What's interesting is that when you look at choosing clearing or going into clearing, it's a pretty simple choice at the moment in some ways, because in credit derivatives, ICE by far dominate. LCH has an offering, but I mean, ICE have billions, getting on for a couple of trillion worth of open interest. Whereas in interest rates, which is the left-hand column, as we go down, the next slide shows the rest of the world. Nearly every country and every clearinghouse wants to do something in interest rates. While SwapClear has a massive, trillions worth, nearly half the world's derivatives are in SwapClear. CME and our friends from Eurex are all chasing them to actually produce offerings that compete. If you go to the next slide, look at the rest of the world. And these slides are in your USB stick if you pick them up. There's plenty of clearing going on outside Europe and America, and I think as regulations develop, we may see that pick up. Oh, thank you. Because it remains to be seen whether clearinghouses outside Europe and America will ever achieve or want to achieve compliance with EMIR and Dodd-Frank. They may actually remain outside and choose to be a pool of risk out there. So Singapore, Hong Kong, Japan are all clearing rate swaps. Korea have gone live recently, and China are also clearing as well. And there's not much data that's public about how much of this is going on, but there's definitely sort of substantial amounts of trades. And all these pale yellow boxes are people who intend to do some clearing. Whether it turns out to be true or not, we don't know. So just to talk about clearing briefly, in the derivatives world, SwapClear for OTC rate swaps has been around for nearly 12 years. And it didn't get to be half the world's derivatives market for nothing. And the main reason was capital reduction. At the moment, there's a big benefit to being clearing because you get reduced capital requirements on your portfolio. It also, to some degree, changes your credit risk from your bilateral party to facing the clearinghouse, which is a good thing if you're worried. And from a settlement point of view, it swings and roundabouts. You still make the same number of settlements, but it's net settlement. It's very organized and very locked down, and you don't have much choice about what you do. You can't dispute, you just pay and dispute in your spare time. So from a settlement break point of view, it's better. And from a cash movements point of view, it's less net settlement. But also, you've got to think about, well, it's not as simple as that. Oh, there we go. On a good day, in business as usual, clearing is something you implement and you use, everybody feels comfortable. But what we're looking for is what happens in default, which Marcus will talk about a bit in coming up. But you've got to have your default management plan in place and thoroughly tested, because if in a crisis your default management doesn't work, then there's really no point in being clearing. It doesn't give you the benefit. So you need backups, you need to think about your seg models, you need to think about custody. It's really important. And then there are costs. You've got to pay to get into clearing, you've got to pay if you're a client to go through into clearing. You're going to have an economic impact on your funding of margin, whether it's variation, initial margin. And there are many buy-side firms who care about the assets they place. then, of course, you've got, in fact, underlying all of this is where are your assets? What happens to them as they move backwards and forwards around the capital markets, especially as they move out of your market into the OTC derivatives? So, I think that's just a bit of background. We're going to talk about, I think we'll kick off with Maud. Basically, Maud, maybe if you want to start the discussion about, why are we moving derivatives to clearing? How does ESMA see the world of clearing? And then we'll see how the conversation covers.
Okay, thank you. Well, just to give you a bit of background, the EMIR regulation came, amongst others, from the Pittsburgh G20 summit in 2009. And it's true that at the time the focus was on OTC derivatives. So the point of the regulators was to try and have first transparency and second clearing obligation on those items. So if we look at the clearing obligation as such, it hasn't started yet. The procedure is that once CCPs are authorized to clear some OTC derivatives, which has been the case, the first one having been authorized in March this year, then ESMA has 6 months to draft what we call regulatory technical standards to decide what class of OTC derivatives should be cleared, and also give a timing for this clearing obligation, having in mind that a phasing is possible. So again, for the moment, no clearing obligation is in place. Considering the procedure that has to be followed, which is first ESMA drafts the regulatory technical standards. Second, those standards have to be endorsed by the Commission and approved by the Parliament. I think it can be fair to say that the clearing obligation will only kick in at the earliest beginning of next year. And this will be for IRS mainly. The point was that if you were going to concentrate the risk of OTC derivatives within entities called CCPs, central counterparties, there was a need for those CCPs to be robust enough to handle this business, and therefore another part of EMIR is to impose some requirements and standards to the CCPs, so that we ensure that in case there is an issue, the CCPs will actually manage to handle default. So I won't go into the details, but there are some organizational requirements, conduct of business requirements, and obviously prudential requirements, which is the biggest part of EMIR. And all this is, of course, to ensure that in case of a default, as you mentioned, the clients and the clearing members are protected. And that the framework is legally enforceable as much as possible in as many countries as possible, and at least in the whole of Europe.
Does ESMA have any view on concentration risk, the idea that we're pushing a lot of business into clearinghouses?
Yeah, so I think it's quite a hard balance to find between concentrating the risk at some point, because you impose a clearing obligation, i.e. OTC transactions will need to go through CCPs and also have viable CCPs at the time. So the point is that in EMIR itself you have some, let's say, hurdles against too much concentration. So if you go into the prudential requirements, whether it's on liquidity or collateral or investment policy or even default management, there are some rules to avoid too much concentration of risk on one country or one entity or even one IT provider, for example. And the point is that at the end of the day, if we rely on all the standards, even though we can actually say that the risk will be concentrated, we hope it's going to be concentrated in entities that are actually able to bear such concentration.
So, Damien. Damien has recently had to look at getting into clearing for his funds, and I think it'd be interesting to hear a perspective about, Damien has some views about the circumstances and criteria by which they allow themselves to go into clearing, even this is before the mandate, because from a fund manager's perspective, it's very important that their assets are cared for, as it were. So maybe, Damien, you could give us a flavour of what it felt like to actually have to approach the prospect of going into clearing.
Yes, I work for Swiss Life, which is a major insurer in Switzerland and provider of life and pension solutions. And we have quite a big balance sheet, and for hedging purposes we have substantial interest rate and FX derivative positions. Now when moving to a central clearing under a standard model, we would be in conflict with Swiss insurance regulation for the safekeeping of policyholder assets. And we have to use some of them to, as initial margin. Now, why is this a problem? Let's say if you have a loss on a hedge, then we have a compensating effect on the underlying. Therefore, the regulator has no problem if we pay the variation margin out of policyholder funds. Because if the CCP defaults, we can just offset the variation margin with the loss. However, in the case of the initial margin, the intent is to have it as a coverage for potential losses. So if those losses do not occur, then the policyholder assets we transferred as initial margins are at risk if either the CCP or the clearing broker defaults. So as a result of this, the same strict rules apply for the safekeeping of the initial margin as in the case of policyholder assets. Now, these rules imply that the initial margin is kept, let's say, segregated, physically segregated, that the custodian is based in Switzerland or Belgium and Luxembourg countries which recognize Swiss bankruptcy laws, and that the initial margin is directly transferred to the CCP. This is obviously not possible in the standard model. And whilst it was fairly straightforward to design conceptually a workable clearing setup, it took us over 2 years to get to a concrete solution. And the reason is that such a clearing arrangement has to meet central clearing regulation requirements as well as Swiss insurance regulation requirements at the same time. And this is legally very complex. So today we have a solution which, let's say, we are confident will work, although regulatory or Swiss regulatory approval is still pending.
So are you saying that you need, what difference does it make in terms of custody and segregation for you compared to, let's say, doing it outside Switzerland?
Well, I cannot talk about outside Switzerland, but I can tell you a bit about what the solution, let's say what the core features are of the solution. So one, we will transfer the initial margin directly to a custody account of the CCP. This custody account is only holding Swiss Life initial margins and is explicitly defined as such. Then secondly, the custodian is based in Switzerland. And thirdly, the initial margin, which we transfer in full title, is repledged to us to protect us against the default of the CCP.
Oh, I see.
So this is let's say, are the core elements of the solution.
So do you think that model might be offered widely by many CCPs, or is it something specialised, do you think? Because it sounds like a physical custody model that I know that some CCPs are looking at.
I mean, we had discussions with all major CCPs in Europe about that. The concrete solution available is CME's full segregation client protection model, which has received regulatory approval, I think, 2 or 3 weeks ago. But given the feature that has, we hope it is a template for other setup, clearing setup as well. Because it will be the only one that, well, that's our view right now, that will work for Swiss insurance regulation.
Sure. So I think we should probably launch into a bit about default management, because one of the things that people need to understand is what is the benefit of clearing. And I think it's a technical subject, but it's sort of the whole point of clearing, which is if something goes wrong, how are you protected? And then I think we'll come back to, how does all this apply to securities lending, equities and bond markets. But maybe if Marcus, we got some slides we can put up, which is hopefully not going to bamboozle you too much, but you can study them in your spare time, which are, what really goes on in default, because this whole requirement in Switzerland to have actual physical and legal protection around your assets is going to the point of sort of maximum complexity and cost, which is hard to do. But, okay, there we go. So we got an overview of what the default process looks like, and maybe Marcus, if you could quickly whiz us through it and give people a flavour of how complicated it is, because I think unless you've experienced the default, you don't really understand how scary the whole thing is. But anyway.
Yeah, thanks, Philip. So defaults, obviously, yes, they don't happen very often, but they can happen, and they're quite critical, as I think everybody understands. This is a brief overview of how the process looks like. It's probably the same, more or less, for every CCP. So we have preliminary measures. That's basically the first point in time where we start looking at portfolios. We start considering contracts that may be expiring shortly. So if we're in the derivatives world, the default happens today. Some contract expires tomorrow. Obviously, there's quite an urgency to deal with these first. We convene default management committees or default management groups. There's different terminology in the business. It's basically a group of experienced traders from major market participants that support the CCP. So they're actually sent from major players to the CCPs to help out with things. The most critical point here, most likely for everyone in this room here, is the transfer of client assets, positions, and collateral, if anyhow possible. And I really have to stress here, segregation is critical, and one has to carefully choose a segregation model. I'll just briefly go into the two basic concepts we have. We have a more individual level of segregation where a member has his own collateral pool, his own positions. They're clearly identified and known by the CCP. And there are obviously several omnibus type constructs where you can be a client together with multiple other clients in one pool. The CCP doesn't necessarily know who the clients are, doesn't know what the setup of positions is, just sees the overall position. So the CCP's business basically benefits from market continuity. This is really critical for us. So we're not there to make the big bang in the next quarter or anything like this. We want to have markets continue. So client business is critical for this. So if there's any possible solution for us to transfer, we will definitely attempt to. We even at Eurex Clearing have a setup where a clearing client who cannot transfer in time could become an interim participant, like its own clearing member for a short period of time, where you may be looking for a backup clearer. So this is the critical point that happens here at this point in time. If porting is not possible, obviously, then client positions would have to be liquidated together with the positions of the defaulting member. The second point in the process, hedging. This is actually quite important. The CCP will try to hedge a portfolio as quickly and as smoothly as possible. So it's a little bit tricky, obviously. Markets will be in turmoil if a member goes down, particularly if it's a large member, as everybody can understand. But this is where basically the transfer of risk happens. Now, what you may very often think is that large banks typically have fairly well hedged positions, which is true, but from a CCP's point of view, that is actually not always the case, because a large member will be operating across the globe, so there'll be positions at different CCPs, there'll be OTC positions. From a bank's point of view, this is one position, it's fairly well hedged, but at the moment of default, the hedge basically breaks up. Every CCP, every OTC counterparty now needs to deal with their problem by themselves. So we do sometimes see positions that seem to be fairly unhedged, even though from a bank's perspective they would be.
I think what will be interesting, if we ever have a real default of a good-sized bank, is the fact that all the CCPs have been managing a default for that bank all at the same time, all hedging
Yes.
and all going out to the market. You've got to imagine that whilst we can sit here and talk about the theory of what happens, in practice, I think, it's going to be an interesting thing to see what really happens in a default when we've now got a structure that sort of says the right way to do clearing, but of course we've now got so many more people in clearing that, again, it's concentration risk, but anyway.
Ultimately, the better hedged the position originally was, the less stress you have in the market. Because one CCP is going to be long equities, the other is going to be short equities, so they're both going to meet one way or the other, and the stress is obviously not as significant if the position was fully directional across all the different marketplaces and CCPs that a member is trading on. But yes, it's critical because it's all happening at the same point in time. Our default management committees, LCH default management group, they'll all be called in more or less at the same point in time, so there's also a stress on your manpower, on your staff, and so forth. Again, it doesn't happen often, but if it does happen, I think CCPs have demonstrated in the past that we're very well able to deal with it. I'm not saying it's easy. There's no guarantee for success, but I think CCPs have invested quite a lot into this, and we're really looking at this with great concern, and we're really working towards solutions here. So we feel very comfortable in being able to deal with this. Again, from a client perspective, what can be very interesting is what we call independent sale or auction. So the solution typically is to have auctions, particularly if it's a very large portfolio, there's many members active in a particular asset class. Now, the clearing fund is what is used at the end if the margin is not sufficient to deal with a loss, and the clearing fund is paid by clearing members. So clients, technically speaking, at this point in time, do not really have a skin in the game here, but clients are a part of the market. And if we want to foster continuity, then we need to include clients, at least in the auctioning process. So at Eurex Clearing, if you are a client, you can participate in auctions if your clearing member is in agreement with this. We find that auctions are more successful the larger the group of participants, because it's quite likely that someone out there is going to have a keen interest in the kind of position that we need to auction. So that works. Obviously, for clearing members, it's a different story. They're part of the clearing fund. There's a lot of skin in the game for them and also for the CCP. There are certain penalty concepts to incentivize competitive bidding from clearing members, clearing fund juniorization, and other penalties. Maybe if we can go to the next slide. This is like a brief overview. A member goes down, you're a client. What does it mean for you? So if you're a client of the healthy member, I'm on the right side of the screen now, basically, you're fairly safe. There's no action that you need to take immediately. Obviously, one bank going down, there could be the risk of this kicking off other members having an issue. So safe, yes, but still, obviously, everyone's going to be quite concerned. But technically speaking, you're okay. Now, if you're a client of the defaulting member, it becomes a little bit more tricky. Hopefully, there is a backup solution, something that you as a client have been working towards, to have some other member that will quickly be able to take you on as a client. If that's the case, then there's a high likelihood for porting your positions. Also, it kind of depends a little bit on the model. Are you individually segregated? Are you in some sort of a pool solution? Different situation. And then one thing that I always like to really stress here, what we've seen in the past typically is a large member goes down, client clearing is considered to be a profitable business. So there's other large members who have a keen interest to take on that business. So what you typically have is someone else stepping up saying, I take all. No questions asked. We're not doing any detailed analysis because there's no time for this. Someone takes just all the business. It's a good solution to deal with the problem immediately, and then it gives everyone in the market time afterwards to sort out, do you really want to stay with this member? Do you want to move on to someone else? All I'm saying is it's a possible solution, but again, nothing we can or we should rely on. Therefore, it is really important to have backup.
I would just pick up on your comment that although you say client clearing is profitable, Bank of New York in America and Royal Bank of Scotland in the UK have chosen to stop doing client clearing because it is highly complicated. I think implementing segregation, meeting the EMIR rules and making it work, it turns out to be almost a considerably new commercial business for many firms, and it's interesting that most of them are having to charge considerable amounts of money for clients to go in and do clearing. So one of the points that's worth talking about perhaps is the cost. Clearinghouses charge relatively small amounts, in some cases nothing at all, to go into clearing, whereas the clearing members, the people who provide you with the clearing service, are having to charge significant amounts, $250,000 and upwards to get in, plus a spread on your initial margin to recover the capital cost.
Yes, absolutely. That's something to consider. But all I'm saying is in the past we've seen exactly this happening, keen interest in the market to take on client positions, which we think is a good thing. So there's a significant likelihood of porting, but yeah, things may change in the future where the cost basis may be different to some degree.
So I think in the interest of time, I was going to say we should probably move on to Gottfried. We perhaps got too much information for you guys to take in. There's a slide you can read on your own about how CCPs defend themselves, but I think really, Gottfried, we're interested in, now you've sort of got a flavour of what clearing is all about. Does it really apply to the securities finance market, to both the repos and equities? Is it really worth doing? Do the costs outweigh the benefits? I don't know. Can you give us a perspective?
Thank you, and thank you for inviting me. You know, it's a fascinating discussion because we're discussing now what do we do in times of crisis with CCPs, which should be the most boring industry infrastructure in the world, right? If it's so safe. And the G20 leader said, yes, central clearing is so much safer. What they didn't realize is that not everything will go to central clearing, because the difficult thing the CCPs don't want to see. And when I speak to George from ISLA, he says, oh, Gottfried, but you know, at the end of the day, you will provide the collateral, right, or the cash, because that's what repo markets are supposed to do. So everybody looks now to the ERC community. You're going to provide collateral till there's no tomorrow. And so what's our experience as repo users? Well, we were probably the first group in Europe to embrace central counterparty clearing in a large way with a few CCPs that we had. And then, yes, it worked. We were very happy. We went to the crisis. It still worked. But then, regulators started to intervene. First of all, through the EMIR procedures, they endorsed nearly monopoly commercial entities. So basically, market has no more power to say the pricing is wrong or not. CCPs can basically do what they want, which actually came to a boil in the sovereign crisis, when a few countries that are still overborrowed, but that seems to be forgotten now already, became so short of funding requirements that their domestic banks couldn't cope anymore. And I was told not to mention this particular country because they already lost the football, so we shouldn't talk about Spain anymore. But you know, as an example, and it can happen in any country really, you know, the domestic market outgrew its capability to finance, so they went finally cross-border in a non-European capital market. Still, we don't have a European capital market, we have domestic capital markets. We went back to balkanization of our markets because of the crisis. And then suddenly, the CCPs in that area, but also in Italy, and probably we get more examples in the future, started to realize we got the wrong risk here, because we have an over-concentration of Spanish banks clearing Spanish bonos in a Spanish default fund. You know, to what degree can a CCP become the middle of the market and then basically is unable to liquidate in case of a default? And so what do you do then? Well, you increase the initial margin, you increase the protection of you increase the cost, to the point that the repo market said, hold on, this is too expensive, let's go back to bilateral. And so the circle is gone right?
If I may, at the time, the CCPs were not complying with EMIR, because basically they only have to comply with EMIR on the day on which they're authorized. So maybe at the time they didn't have all the requirements in EMIR, including procyclicality requirements, etc., in place, and also the requirement to try and avoid this kind of vicious circle. But I don't know the precise details, but
but the wrong way risk is still there, right?
True.
I was in Poland 2 years ago with European football. I didn't go to the football. I went in between football matches, because otherwise you couldn't get a hotel in Kiev or in Warsaw. And there, you know, the regulators were very keen. We want a Polish CCP clearing every possible product with Polish banks and a Polish zloty collateral, right? Oh, God, great. Here we go. So we have multiple CCPs. We have far too many. And so eventually we're going to have to become a bit more rational. And so they become then too big to fail. or they shouldn't fail. It's clear when I speak to officials, and I won't mention names, Gottfried, of course, we're going to bail out CCPs when they go in default, right? We cannot let this happen. So what did we achieve? We made the industry more and more expensive. I'm not negative now, I'm just realistic. We made it more expensive for the industry, and at the end of the day, we didn't solve a default, right? A default, you as taxpayer are going to pay whatever you want to do. So that's one of the issues that we work with. Now, CCPs in the repo market, of course, helped us in netting. It took away counterparties to a certain degree. And we were actually, and John Burke, we remember this, we were actually hopeful it would take away our, how should I say, nightmare of collateral management in the different Eurozone countries, and basically that didn't work either, right? So we still have massive spaghetti model in Europe, which now actually comes to the boil again, and Chris Redmond in the next panel can talk about it, the mandatory buy-in, right? That's not going to work either the way it's envisaged. So we actually are now coming to the point that the work of the last 5 years, through ESMA and the regulatory requirements in level 1, you see all those different regulations coming together, and you see, oh my God, what way have you done? Have we actually achieved safety? And I think we actually starting to see now more pain points than we actually were aware of, because we get, of course, in discussions with regulators. And so I think as a community, repo community, but also the ISLA community and everybody, I think we need to engage more with the regulators and the politicians, but God forbid, right? Politicians don't understand this debate anyway. I heard that yesterday already from the hedge fund industry. So I think, the repo market has a lot of experience. We have very knowledgeable people. We have people on the risk committees of CCPs. The job isn't finished by far and large. And one of the focuses we should actually look at more is, okay, if we know there is going to be a CCP default, and my bet with Patrick Pearson is within 5 years we see a default, right? We never said how much money we put on the table, but we have a bet that it will happen. What should we do to prevent that? And I think we see this now in the derivatives, but there's also discussion now in the repo market and probably in security lending as well. What can we do to reduce the outstanding? So the post-trade services that are now coming up here and there, I think we should focus on what can we do to make the system safer before we actually come to a default. And I think that's also one of the focuses in MiFID. Page, I don't know, from the 800 pages, there's 3 pages about this only. But I think we need to put all of those together, re-look with the new commission, and that's happening now in Brussels. They kind of started to reflect where did we go too far, and then take lessons from that and refine the system. So CCPs are good, not good for everything. They're not safe yet. And the final word on that, and I keep repeating this in conferences, yes, we're going to get the mandated CCP clearing, but we have no recovery and resolution yet.
Yeah, but Gottfried,
So,
if I can kick in here, so you're talking a lot about concentration and you're indicating CCPs are not safe. We know concentration is a problem, a major problem. If we have a default, it's not so much that I'm worried about the individual positions I have, I'm more worried about the concentration of positions. Now, what you're saying is that because we're looking at this now, everyone's becoming aware. So a problem that was there before that we're just not aware of is a problem nonetheless.
Yeah.
And moving it to CCPs and having us look at concentration so roughly is actually increasing the safety in the system. And when you say you expect a CCP to go down in the next 5 years, bear in mind that before that happens, you're going to have a lot of banks failing. So the CCP isn't just going to stumble and it's done. It needs a certain crisis, a serious crisis, to get CCPs to the point where we really have a problem. And I think that's exactly what you want. You want us to make sure that concentration risks are being accounted for. So if your position is completely concentrated in one jurisdiction, again, I'm not going to say the name. I know you've lost the soccer match yesterday, and it's quite critical, yes. But I mean, that's the kind of position you have to do something about.
Yes, but you also mentioned...
Guys, unfortunately, we're running out of time, so we're going to have to... We could have had a good debate. Unfortunately, I have to move on and ask you guys if you've got any questions. I have a final e-vote, so we're just getting in a good flow there. Has anybody got any questions about clearing to any of the people on the panel? So you all fully understand clearing, you're all completely comfortable.
If I may just have a last remark, I think that Gottfried made a very good point, and you'll be happy to hear that EMIR review is already foreseen by EMIR itself, and ESMA will have to write a report on how EMIR is applied and let's say the pros and cons. So I would definitely encourage everybody to as much as possible, look at the consultation papers on our website, etc., and give the feedback. We received a lot for other regulations and also for EMIR. So I think the community should definitely carry on doing this so that they make sure that at least their voice is heard. I'm not saying that all the voices will finally end up in the documents, but at least the more feedback, the better for us.
Yeah.
So if we could round out, I want to go down the panel and say, as a normal individual, separate from your professional life, do you think we're safer now with lots of clearing?
Obviously, yes. No, honestly, risk management doesn't come free, but it's necessary, and it's what clearing provides. So I think, yes, it's safer to have it.
Well, I have my doubts in, let's say, that if you mentioned before, if a lot of banks need to be in trouble for a CCP to be in trouble as well. So there I see the possibility of a huge systemic problem, because then everything comes together. But let's say, apart from such worst case, let's say, scenarios, we think that central clearing could, let's say, help to still have liquidity and access to markets in stressed markets. So we have a positive view.
Yeah, and I would agree with Marcus, and I would say that knowing that there is a risk doesn't mean that it doesn't exist, but at least you take all the measures you can to actually mitigate the consequences. And that's why also in EMIR there are requirements for testing and stress testing, not only default procedures, but all other items. And hopefully, I mean, we're heading toward more risk mitigation.
I think we have only started to possibly go to a safer environment. And the key is liquidity. How liquid are the protectionists, the bonds we put into the default fund, for instance. And this links then to MiFID, right? You say you haven't decided yet what will be mandatory clearing. You will start with some interest rate swaps. I sit in the MiFID Secondary Market Working Committee, and they're not even really sure what's going to be a liquid bond, never mind a liquid corporate bond. We all have seen what the first Fed signal did of stopping quantitative easing, how the cash bond market sold off. It's in a very low interest rate environment. When interest rates go up, then there is no real secondary market anymore because the banks don't warehouse anymore. That's the bonds we give to the CCPs for protection. So if there is a real sell-off, how fast can the CCPs then liquidate in case of a default? So I think we need to put everything together. So we're going in the right direction, but I think we need to do much more work, and so that's why I probably stay a few more years in this industry.
Yeah. I think my own view is that if a research organisation had built a model of the capital markets where they could test scenarios and say, what is the outcome of various bad stuff happening, and measure it and model it, like an engineer would, we could all then decide whether or not we feel safer. But the fact is, as far as I know, there isn't any model anywhere in the world that says, how does the market work? So in fact, it's all theory. Anyway, we've got a final e-vote just to see if you guys are any happier about clearing. I'm not sure if I press the button or you do it. There we go. So if you could vote again, and just see if you've changed your opinion, if you feel differently about clearing, if you understand it more, or in fact we scared you into understanding less. Let's have a look and see if we made did we move the needle? Whoa, positive outcome. 4% of people feel better. Good. Oh well, if you've got more questions you want to ask offline, meet us in the foyer, and thank you for listening. Thank you.
Thank you.